Good morning there, William. William says hi. Good to see you guys. We're going to be talking about the single most important key to trading in 2015, and indeed always. And it's not about picking stocks, and it's not about timing trades, but it's more about this interesting concept called position sizing. Okay, and position sizing is the most important factor in your trading decisions. But the one factor that seems to be neglected or seems to never be talked about or taught. And once I figured this out, it helped me to take a losing trading record, a losing system for picking stocks, and turn it into a winning system as far as coming out ahead. Coming out ahead in financially. And so today we're going to identify the problem. Okay, we're going to identify why that problem hasn't been solved yet. We're going to see what's possible. We're going to see what's different now after I show you what's possible. Okay, what has changed, and finally decide what we need to do next. And so that's kind of an overview of today's class. Usually when I'm looking at a new situation, okay, I'm a new person to a certain concept or idea, school of thought. My first question that I ask myself is, hey, is this for me? Okay, is this necessarily something that I want to be involved in or that I think is going to be important to my life? And that's an important question for you to ask. And I'm going to go ahead and tell you what I think is congruent with what you want. All right. Are you interested in knowing how to protect yourself from loss? If so, I'd say, yeah, this is for you, this program. Okay. Do you like the idea of taking income from stocks? Now, a lot of folks have gotten into options trading by way of what I call the gateway drug, and myself included. And that is that I went to a weekend seminar and learned about covered calls trading. Okay. Also learned about spread trading. And the idea was with spread trading, the idea was to leverage some trades. And the idea with covered calls trading was being able to take money, take income while you're sitting on a stock. And that to me was kind of a sexy idea. So if that appeals to you, I'm going to be sharing some of that with you, but I'm going to be sharing a way to do that. Actually, there's 12 different ways to do that. Okay. Also, normally when you do the most popular and well-known method of taking income while you're sitting on a stock, while you're doing that, it actually limits you from growth. And what that means is when you're doing covered calls, for example, when you're doing covered calls, if you sell a short call and you're holding on the stock and the stock just blows up, it goes way big to the upside, you don't get to participate in that upside. All right, you've obligated yourself to deliver the stock at a lower price to someone that was a speculator, and their speculation proved to be correct. And guess what? Although you get out at a profit, you don't get near the profit that you would if you had simply held on to the stock. And so for that reason, I developed radioactive trading to leave the upside open. And so if you're interested in how to participate in growth, but still do some of these income generation strategies, I think this is for you. And then finally, we are going to touch on this. We're not going to really emphasize this too much today, but we are going to touch on this, the way to bulletproof a stock. Now, I wouldn't make the claim that you can do this every time, but I am going to say that it's not a rarity. All right. It is something that we do on a pretty darn regular basis. We do it as a matter of course. A lot of times in the stocks, we're sitting on a stock, we're able to take income that offsets the cost of our insurance policy, the put option that we buy on the stock. And by doing that, we keep ourselves out of trouble and make ourselves what we call bulletproof. Okay, so kind of cool. Okay, so the radioactive profit machine is what we're going to be sharing today. It's a unique variation of the traditional married put play. And we'll be featuring income method number 6, which is a riskless spread trade. No joke. It's a riskless spread trade that creates income while at the same time leaving your upside growth open, leaving your upside potential open. So kind of cool. All right, so this webinar is going to introduce you to a new and better way to trade, a way to cut losers short, let winners run, and get paid while you're doing it. Okay, so folks, what I'm going to do real quick is hit a poll here. I'd like to know just a little bit about you. Okay, so what is your participation of, or I'm sorry, your level of participation so far with radioactive trading and power options? Just like to know that for my personal use and to be able to further work with these webinars and make a more educational choice. Okay, all right, very good. We've got a lot of folks that are already owners of the blueprint. That's marvelous. Okay, a whole bunch of what I call repeat offenders, folks that have come to my webinars and they're back for more. Good for you. We've got a smaller amount of folks that are Power Option subscribers, and a smaller amount of folks that this is their first Radioactive Trade webinar, but we do have a few of you. Okay, let me leave that poll open for just about another 5 or 10 seconds. Okay, and I'll go ahead and close it in 3, 2, 1, close. All right, and at the last moment there, it became even numbers. Okay, so 60% have recently bought the Blueprint or Home Study Kit. Marvelous. That's at the bottom of the list. 40% been to other radioactive trading webinars, back because you're learning. That's great. I'm glad. And then 20% and another 20%. This is your first radioactive trading webinar, and 20% saying I'm a Power Option subscriber. So thanks a lot there, guys, for that participation. I really appreciate it. Okay, so on with the show. This is not me. This is my good friend Mike Kepka. Mike introduced me to the founder of Power Options, Ernie Renner, back in 2007. You see, I was a customer of Power Options. And Mike's function at the time, he is now the Director of Options Education, but his function at the time was, and something that I believe he still does for the company, is that he'll show folks how to use the platform to find the kinds of trades that they're looking for. And so I called in and I said, hey, look, I'm looking to find stocks that are in this price range and this level of volatility. And what I really want to do is I want to pair these stocks with put options that are far, far away in time and a little bit in the money, so that I keep my risk down to, say, 4, 5, 6%. And Mike looked at what I was doing. He looked at the setup and he said, I kind of understand what you're getting at here, but, you know, and it's certainly a good idea to keep your risk low, but I don't see how you're ever going to make any money at that. And that's actually the way that a lot of folks that have just taken a knee-jerk reaction, just seeing the setup and said, well, I don't know if that's going to work. That's a very common reaction. But now Mike is on board. In fact, he began to win consistently for the first time in his trading career after beginning to use my plan and program and the principles that are behind it. Okay, his own trading had been impacted by losses, and by that, what I mean is he had done all kinds of different things. You know, short straddles and iron condors, butterflies, and covered calls and calendar calls. In fact, calendar calls was something that Mike said made him the most money when he was right, but conversely, it also lost him more money than any other strategy he'd ever done. What happened was Mike decided to give it a shot. He decided to give the radioactive trading thing a shot after coming to one of these free webinars that you're part of now. And in 2008, even though he was long stock for the entire year of 2008, he only had a single-digit % loss. I thought when I wrote this, I thought it was 1.5, but he recently corrected me. He says, yeah, it was actually a little less than 1%. Okay, so he lost less than 1% in 2008. Well, what's that mean? You know, we're not going to trade with the intent of losing, even if it's only losing 1%. Well, get this. You see, part of Mike's deal is he wants to be long stock. Okay, he wants to be holding on to those things for the dividends and other reasons. But guess what? When you lose only 1% in a down year, where the stocks go down by 40% or worse, guess what? At the very bottom of the market, you're investing with 99% of your capital still left. And that's what Mike has done. So since 2008, what is it? 2009, 2010, 2011, 2012, 2013, 2014, and now still on track here in 2015 for double-digit gains per year. Okay, not shabby. So Mike struggled with options at first. He got control, and now he's got over 6 years of double-digit gains to look at. So, folks, doing pretty good. Doing pretty good. I share Mike's story because I want you to know that the system is teachable. I can talk to you about my success, but you probably are more concerned about your own, right? All right. So what we're going to do here today, I've got a couple of stories to tell, and one of them is a financial fable, and this is a true story. I'm embellishing it a little bit with some animation and cartoons and so forth, but this is a true story. A legendary trading coach named Ralph Vince gathered together 40 PhDs, and these 40 PhDs, very bright people, were given 1,000 virtual dollars to trade and a game which is very winnable. Okay, in fact, a grade school student, fourth, fifth grade, could take this system and make a fortune with it. Okay, so this is a story of the 40 PhDs and the Martingale. Now, we'll see the Martingale here in just a moment. The Martingale is a scaly green, crazy creature that with dollar bills for scales, and he wants to steal your money. Okay? Well, here's the deal. These 40 PhDs were given a game in which they had a 60% probability, 60% chance of winning each play. And they were given 1,000 virtual dollars to play. And it was random, it's 60% chance, all right? And they had even money return. That means that if they bet $20 and they were right, they got their $20 back plus another 20, right? And if they were wrong, then they lose their $20. Okay, so it's even money return, 60% chance of winning every play. Okay, now most of these PhDs, some very bright people, had their butts handed to them. And this is crazy because a fourth or fifth grade student understanding basic principles of math and given some very simple directions could make a killing with this system, and they still lost. Okay? Well, here's the deal. They got a lesson in humility because of the Martingale. Martingale principle means that once you lose a certain amount, you have to gain it back with a more risky bet than before. Okay, and what happens is there was what they call expectancy in this game, expectancy of 0.20. And expectancy, I'll give you the equation a little bit later on. This isn't going to be strictly a math class, okay, but for those of you that are mathophobic, all right? But essentially what has happened here is that game that Ralph gave them has an expectancy of 0.20, and what that means is for every dollar that they wager over time, if they don't blow it, okay, if they don't meet up with the Martingale, if they bet $1 over time, every dollar that they bet is going to return them 20 cents, okay? And so that's what expectancy means, and it's the thing that Vegas uses against you and me, okay? In fact, their expectancy might be very low. I've seen in Vegas, I've seen where they've published, hey, we pay back 97% of our winnings, or 97% of our income to our winners. Okay, so 97% of everything that's wagered goes back to the winners at Vegas. Well, great. What that means is 3% over time of every single dollar ever bet is going to go to the house. All right, so that's what expectancy means there. So these folks should have won, but that's not how it worked out. Almost all these PhDs lost, and here's why. Most of the players used no rhyme or reason to their betting. They'd maybe bet a few times and then win, and then being encouraged by this, they'd increase their bet size and then they'd lose, okay? And then, they become conservative again, and when they were winning, and here's what happened. Out of the 40 PhDs, 38 lost money. Some of them lost all of their money. It's a good thing it was virtual money. All right, it's $1,000 of virtual cash. Okay, now since all 40, there's 40 of them, and 38, that's 95% of some very bright people. Okay, Since 38 of them lost, we know that 2 of them won. Well, here's how it may have played out. I actually don't know the numbers, okay? I don't know what happened, but maybe one of them was conservative, and so what he did was he went with a standard bet every single time and bet $10, all 100 plays, okay? And with a 60% probability of winning, we can reasonably expect that he won, about 60 times. So that'd be 60 wins times $10. And of course, if he wins 60 times, he's going to lose 40 times. So that's 40 losses times $10. So $600 minus $400 equals $200. And so that's what happens when you bet 1% of your pot, okay? Every single time. Here's what happens. It's a 20% profit. Well, somebody might have been a little bit more aggressive. She figured that, hey, I'm probably not going to get 10 losses in a row. I've got $1,000. I'm probably not going to lose $100 10 times for my first 10 plays. And she probably would have been right if she'd have done this. And if she had bet $100 each time, well, that'd be 60 wins times 100 minus 40 losses times 100 equals 6,000 minus 4,000 or $2,000. Starting with $1,000, making $2,000, which is a 200% profit. Okay, pretty cool. Pretty cool. All right, now we've got the 38 that lost. We've got the 2 that won. 2 of the 40 traders did win, but this is what I want to point out to you. I want to point out that the only difference between the losers and the winners was position sizing. Okay. Indeed, in this example, that's the only thing that it could have been. It's not like they were tuned into a stock picking newsletter, right? It's not like they were watching charts and trying to predict the motions of the markets. What they were doing was they were all playing the exact same game with the exact same starting capital, but they made different decisions along the way about how much they were going to bet, and that was it. That's the only difference between the losers and the winners. And again, 95% of some very sharp people ended up having their butts handed to them. So more important than choosing a strategy with positive expectancy is the proper use of position sizing to keep you out of trouble. Okay? Now, this is the equation that goes along with finding the exact right amount. You see, neither of those two winners use the exact right amount to bet. This is the equation that will tell you how much you should bet. Okay? And guess what? I don't know what the results of this equation is going to be for you. You're going to have to figure that out as far as knowing what your average win is and the average amount of times that you win, and your average loss and the number of times that you lose. And then you're going to also probably have to make a few adjustments to that. But once you know all those things, okay, you can look back at your current trading record and make some inferences from there, and then decide, geez, how much should I be betting? Okay. Now I'm going to give you some practicals here in just a moment. I'm not just throwing you to the wind, but we've got, out of 23 different folks on the line right now, we've got, I'm sure, 23 different situations. Okay. So, by the way, here's the proof for this big equation. Oh, hang on. There we go. Somehow my phone I didn't silence. Sorry about that, folks. Get that fella turned off. Okay, very good. Okay, so here's the proof for that big equation. But the point is, there is an ideal amount for you to bet. It's just like the 3 bears, okay? The ideal bet in this case is 20% with a 0.120 expectancy. 20% of whatever your bankroll is what you should bet in each play. Okay, 20% of your bankroll in each play. And the return is respectable. You see, we saw where a very conservative bettor might have gotten 20%, and a more aggressive bettor might have gotten 200%. But if we bet the exact right amount every time, it would be something more like 648%. Okay. Now, what does this have to do with you? Well, a lot, because we've got to figure out what's going to work for us. If we bet too much, we're going to get our butts handed to us, just like those 38 PhDs, okay? And then even if we end up being one of the winners, there's a big difference between a too conservative bet and a more aggressive bet that's still a winner. Okay. But if we can find the ideal, boy, that's going to be just right. And that's why I call this the story of the three bears. Okay, now here's what we're going to do. We're going to do a little, a little history lesson here. What I'd like to do is I'd like for you to tell me what has gone on for you in the last 12 months. Okay, what has gone on for you in the last 12 months? What was your experience trading? Did you pick more winners than losers and make money? Did you pick more losers than winners and lose money? Did you pick more winners than losers but still manage to lose, which it's possible to do if you don't keep your losses in check? You could actually win more often than lose, but still lose too much and end up behind the eight ball. Okay, are you one of the minority that picked more losers than winners but still managed to win? Okay. And or maybe are you ready to quit just to stop the hemorrhaging? So I'm going to leave that poll up there for just a few more seconds. Oh, it's all over the board. We're having a lot of people vote. I appreciate that. 59% of the room has already cast their vote. And at first there was, wow, there's a whole lot of representation in one category, and then it flip-flopped. And okay, so I'm going to leave that up for another, 5 seconds. 64% have voted. I'd like to have 100%. I'd like to have everybody vote. I know that some of you are just calling in, so you can't. So, all right, let's leave that up for 3, 2, 1 second, and close. We've got a tie in there. All right, let me go ahead and read these off. 21% picked more winners and losers and made money. Good for you. Awesome. Okay. Now, another 21% picked more losers than winners and lost money. And that doesn't surprise me. I mean, if you're losing more often than winning, you're going to very likely lose money. Okay, 43%. This is disturbing. 43% picked more winners than losers, but still managed to lose. Okay, guys, I can help you more than I can help anybody else. Okay, I can help you more than anybody else. This would be a game changer for you. It will be a game changer for you if you pick up and use the lesson today. Okay. All right, finally, 14% said I picked more losers than winners. Oh, and still managed to win. How about that? Now, nobody says that they're ready to quit, and so that's encouraging to me. But let's take a look here. We've got folks that are losing in the middle there, 21% plus 43%, that's 64%. It's about 2/3 of the room. And what is the other 1/3 of the room doing? Well, obviously, some folks are picking winners. They're just being lucky, okay? But being lucky isn't good enough, is it? Because more than double the amount that picked more winners and losers and made money, more than double that, 43% said, I picked more winners and losers, but still managed to lose. What's going on? Well, I'd say that you're probably some very bright people, just like those 38 PhDs that lost. What can we do about this? Okay? What can we do about this? How do we apply this in real life trading? Well, let's start off with I'm going to look at a very leveraged position, okay? Because I know that some of you probably play long calls and puts and that. Oh, what I'm going to do is I'm going to give you a pop quiz, okay? Pop quiz. Don't worry, there's only one, all right? And here's the pop quiz, okay? Let's say that I give you a leveraged play where you can buy calls and you're right some of the time, okay? You make 66% when you're right. And when you lose, you're able to manage your position and get out with not too much of a loss. You're able to get out with only a 40% loss. The problem is you lose most of the time, okay? You lose 60% of the time. Now, if this is your record, okay, if you could look back at your record and say, I pick winners about 4 times out of 10. But I can leverage this instrument to where I can make a 66% gain, and only have a 40% loss if I happen to be wrong. Is this a good game? Does this make sense to you? Okay. And if it does make sense to you, why? Now, I realize that I haven't given you enough time to break out your calculators and so forth, but I've given you some inferences here, okay? All right. So one idea is, yeah, because 66% is greater than 40%, a 60% gain is greater than a 40% loss, so even if I lose a little bit more often, it's okay, right? Or you might be thinking, it's unlikely that I could win this. The 60% probability of a loss stacks that deck against me. I don't know. I don't think so. I don't think I'm going to win. Okay. Or would you say, hey, you know what? Absolutely not. Absolutely not. The 66% gain doesn't offset a 40% loss. And if I'm taking more losses than wins, it's never going to happen for me. Okay. Maybe you think, that looks like a losing play, but I like the action. So I'm gonna go for that 66% gain, and I'll just get out when I'm ahead. Okay, it looks like a losing play, but I bet I could win it. Okay, and finally, it looks like a winning play, but I bet I could lose it. And you know what? That could be the case. Okay, let me go ahead and close that. And it's interesting because look. Some categories were completely avoided, and others we've got divisors of 11 here. Look at this. 22% say, yeah, 60%, 66% is greater than 40%. Even if I lose more often, it's okay. It's no big deal. Okay. And then a third of you said, no, that 66% gain won't offset a 40% loss. And guess what? That is true. If you have a 40% loss, well, think of it. Okay, if you had a 50% loss, what needs to offset that? Not a 50% gain. You need a 100% gain to offset a 50% loss, don't you? Right? You have to double your money if you half it. If you cut it in half, you got to double it. Okay, so yeah, guess what? Okay, now 44% say it looks like a winning play, but I bet I could lose it. Well, okay, folks, tell you what. Let's see how to win this, because it is possible to win this, even though it's not a winning play. It's not a winning play, but it's possible to win it. That sounds like a contradiction, doesn't it? Well, check this out, okay? Over here on radioactivetrading.com, if you go to the Trade Simulator tool, this is a nice instrument, a nice tool to help you learn how to manage money. Now, I've put in the target return of 66%. I've put in the loss limit of 40% and a probability of a loss of 60. Now, starting amount is $10,000. We're going to invest everything each time we play, and we're going to leave commissions out of the picture, although that does make sense for you to put in your commission, whatever it is that you pay with your broker when you play this game. So, simulation results. Well, here's the thing. Whenever the balance dips below $250, it says that you're bankrupt. Okay, so we start with $10,000, 10 winning plays, 18 losing plays, and guess what? The high value was 16,000. So at one point we're up by 64%, right? But then the low value is where we busted. Okay, wow. Let's run that simulation again, because it's based on probability, and the probability of a loss is 60%. Okay, well, this was too many losses right from the get-go. Here's a longer record. Looky there, 24 wins, 32 losses. We still ended up bankrupt. And then finally, yep, there we go again. Okay, 6 wins, 14 losses. Boy, oh boy, goes from bad to worse. Okay, now I want to take a look at something here. At one point, here we are with $10,000, and at one point, our high value was $45,000. So we might mistakenly at that point believe that we have a winning system. And it looks like some folks believe that they're going to be able to beat this. They look at that and they say, you know what? I would have just gotten out. I would have done the $10,000 and I would have gotten out when I got to 45,000. Oh, really? Would you really? If you took $10,000 and turned it into $45,000, I think like me, you might get a little cocky, and you might continue trading that system. And as you can see, it ended up in bankruptcy again. Okay, but watch. I'm going to make a change here. And the simple change that I'm going to make is I'm just going to change our position size. And what that means is, instead of betting the whole pot every time, we're going to leave the same parameters in place but all we're going to do is bet 10% of whatever it is that we have. And now, hey, behold, even though we're losing more often than winning, we're still having an overall winning record. Let's try that again. Roll it again. Hey, look at that. You know, what's really good about this is that even though we're taking $10,000 and we're more than doubling it, when we have a drawdown, it looks like here we had 3 losses in a row. We ended up with a what do you call it? A drawdown. A drawdown of maybe 5.5%, 6%. See that? Okay. Here we are rolling it again. This time we had a drawdown of 12%. Ooh, but then we ended up making 37%, even losing more often than winning. Do you see that? Isn't that cool? Okay. All we've done here is we've decided to only bet a portion, only put at risk a portion of our funds. We could be playing the whole pot, but I'm getting ahead of myself. Let me go ahead and show how this is done. This is a quick overview, and then we'll get into the nitty-gritty numbers of the Radioactive Profit Machine. Okay? So let's say that we're buying in at our stock at this dotted line. The stock could go up or it could go down. All right? Now, if it goes down, it could go down to 0. And if it goes up, it could double or actually even do better. Okay? But the dotted line is the cost basis. Now, the fact that we could lose everything sucks. Okay, I mean we could lose everything. The value of that stock could go to 0, and you know what? That has happened to me. I've been in a stock that I bought in at $9.50, and it went up to $24. And of course I couldn't sell then, you know. And that stock ended up. I got out of it when it was at 26 cents before it hit the pink sheets, which means that it was valueless on the open market. So that is possible. Okay, so anyway, here's how some folks will combat that idea of losing all of their money. And what they'll do is they'll take a covered call play and use that to reduce the cost basis. So if this is where we bought in with the stock, we accept a small premium, and that small premium lowers our cost basis. So now, instead of paying this much, we've paid only this much, right? And instead of losing everything, guess what? Now we could only lose most of everything. We can only lose 97% instead of losing 100%. That's the good part. The bad part is this: you also cap your upside. That's the price of doing the cover call play. You cap your upside. If the stock is a winner, and you'd be foolish to buy a stock that's a loser, okay? But if you're a winner, then you just don't get to win much. That's all. Okay. What you're going to do is hand that stock over to someone else that you sold the call to. Okay. So that's how the covered call thing works. What about the Radioactive Profit Machine? Well, the Radioactive Profit Machine is a little different. What we do is we buy into the stock, which could go to the moon or it could go bust. And what we're going to do, instead of accepting a small premium to hedge this stock, we're going to pay a small premium to hedge this stock. And we're going to limit how much we could possibly lose, but our upside potential is going to remain. So instead of paying this much for our stock, guess what? We're going to pay that much, just a little bit more. And what do we get for our money? Well, what happens is now instead of having a stock that has unlimited upside, but it could lose everything, now we have a stock that has unlimited upside, but it can only lose 3 or 4 or 5%. How about that? Okay, so that's the idea. That's the Radioactive Profit Machine. Each stock has its own volatility signature. So, for example, you bought into a stock that could vary by 15% to the upside or 15% to the downside. What you're going to do by inserting this structure, by adding this put option to your stock, you're going to limit your growth by a tiny bit. Not as much as the covered call play, but you are going to limit your growth by a tiny bit. So say you spend 5% on your put. Well, now instead of being able to make 15%, when the stock goes up 15%, you're going to only make 10. On the other hand, instead of losing 15% when the stock loses 15%, you're going to lose only 5. And so what happens is now we're risking nickels, but we're making dimes. And we've added skew to our trading. We've added skew. We've actually increased our expectancy just by doing this one thing. Just by doing this one thing, we've increased our expectancy. Now, I'm going to give you a practical example of this. All right, and then after the practical example, I'll be able to take a few questions. Let me go ahead and take a look here and see what kinds of questions have already come in. I've been ignoring the. Okay, good. Stephen said something about futures. I'm not sure what you mean there, Stephen. Maybe you're trading futures. Okay. Okay, not a lot of questions. We've got a whole pile of you here on the line, but I guess I'm keeping your interest and we're keeping it going. So go ahead and type in your questions. If it remains unanswered for a few minutes, it's because I'm looking at my screen here, okay? But I will make sure I jump in there and answer your questions. Okay, so practical example. Here's, what is this? CAT, Caterpillar, okay? And Caterpillar is trading at $84.20. When was this? In February. Okay, so in February, that's what's happening. Now, the stock price is $84.20, and at that time, the August 87.50 put was at $7.60. Okay, so adding these together, we're spending $91.80 for 100 shares of stock that are insured. Where is it insured? It's insured at the level of 87.50. That's that put, after all. We're going to get back our at least 87.50 of this entire investment. And you might look at this and say, well, that's a lot of money. That's more than 5% of your underlying cost, right? Well, actually, I'm guaranteed to get most of that back, or much of it back. I'm guaranteed. What we've done here is we've solved for the time value. We've solved for the time value of the put. Now, some folks will stop me and they'll say, Kurt, wait a minute. I could do the same thing with a long call. Well, actually, no, you couldn't, because there are 12 different income methods that we can do with this position, and many of them it's either not legal or possible for you to do with a long call. Many of them. Okay, it's not legal or possible for you to do with a long call, but you can do it with the Mary put. Okay, so those income methods are one reason why you'd want to do this. Another reason I've already shown you. The other reason is forcing yourself not to trade too many contracts. That's the idea. If you've got $10,000 to trade, you could buy a boatload of long calls, all right, and you could also get hurt. But you could only buy 100 shares of stock and one put option, okay? And so what we've done here is we've painted ourselves into a corner to where we can't lose any more than 4.7%. Okay, now there's still unlimited upside, and there's still the possibility of capturing income that'll offset the cost of this stock. There's still that, all right? But let's take a look here. This blue line is the value of the stock plus the put at expiration, but the red line, what that is about halfway between the purchase and expiration. Okay, and what happens is if you get out early, either you lose less if you were losing, or you make more if you were winning. And so that's why we are buying a put option that's far away in time, but we're not obligated to hold it. Okay. All right. So again, $4.30 per share, or $430 is the most that we could possibly lose in this transaction. But as far as how much we could win, it's unlimited. Okay. It's unlimited. It's only limited by where that stock can go. Okay. All right. Now, 4.7%. Now, here's why we bought that put option so far away in time. You'd think that buying the put far away is expensive, but it really isn't. And here's why. Time value falls off slowly at first. Usually, in a married put position, what the people will do is they will buy, the people that are using it as a hedge, they'll buy a put option that's near to expiration and out of the money. Out of the money, why? Because it costs less. It doesn't protect as well, but it costs less. Okay? And near to the money, why? Well, because they don't want to spend a lot on time value. Well, here's the thing. Time value is something that definitely, absolutely, always is going to go to zero. It's going to go to zero. So what would you like to do? Would you like to hold on to your put option for a month and lose a tiny amount during that time and get out when there's still 3 months left? Or would you like to buy your put option 1 month away and be certain of losing it all in 1 month? You're going to lose all of that time value if you hold till expiration. But if you only want to hold a month, don't buy it with 1 month of expiration. Buy it with 120 days of expiration and get out at 90. That's the simple truth here of how the radioactive trading, radioactive profit machine works. Okay, our idea is that we're going to offset, using the income methods, we're going to offset this tiny amount of risk that we have with the income methods, and we're going to either bulletproof ourselves, or we're going to get out with a win, or we'll get out with a small loss. If we lose, it's heads, you win. Tails, you don't lose much if you lose. All right. And so what I'm going to do right now is just ask you guys what you think about that. Okay. Think about what I just showed you. If every loss that you took last year was scaled down from whatever it was to 5% or less, would it have been a better year? All right. Think about that. Also, for those of you doing covered calls, if you'd have left the upside open instead of, making certain that that you have to deliver your stock if it's a real winner. All right. If you left your upside open, would you have done better? Okay. Let's think about this. So far, I've got 100% in just one of these 4 categories. Okay. I've got a slide up that says, to confirm the truth of what I'm saying, think back to your record. Would the radioactive profit machine change it? Even if you had the same picks and the same timing, but you just lost less on your losers, and you left your upside open, would it make a difference? I think probably for many of you it would. Okay, now I've got responses in all 4 categories. I'm going to leave the poll up for another 3 seconds, 2 seconds, 1 second, and I'm going to close it. Okay, very good. Okay, so 22% said, nah, you know what, limiting my risk to 5% would not have helped my trading. Okay, that's fine. I think you'll still find radioactive trading attractive when I show you one of the 12 income methods. Okay, I think you'll still find it attractive. 11% said, you know what, I may have lost last year, but I would not have lost as much. Okay. Look at this. 44% said, yes, I lost this year, but this would have made me a winner. Awesome. I think that 44% is very suspiciously close to the number of folks that said that they won they picked more winners last year, but still lost. They still lost money. All right. And then 22% said, yes, I did well last year, but I would have done better using this. You know what? Let's just make a comparison. I'm going to go back to, where was it? What statement best describes your performance? Okay. There in the middle, it says 43%, I picked more winners than losers, but I still managed to lose. And see, that's 43% saying that. That's suspiciously close to the number of people that said, I lost last year, but this would have made me a winner. And take a look, 22% more said I did well last year, but I would have done better. You know what? Just a quick follow-on poll. Okay, I know this isn't going to be all about polls. Okay, I've only got 2 more to give you. Okay, but looking at this one, how much better off would you be? How much better off would you be, assuming that you had the same win-loss ratio last year? Okay, but you had no losses of more than 5%. Some of you said that you were a winner last year, but you'd be more of a winner. Some of you said that you lost last year, but you would have won if you'd have done that. And some of you said that, hey, maybe I would have still lost, but I would have lost less. Okay, so I'm just going to ask a real simple question. Put a number to that. Put a number to that. Would you have not done better? It's okay if you say you didn't do better, or you wouldn't have done better. That's okay. Would you have saved or made enough to be ahead by $500? Would you be ahead by $1,000 or more last year alone? Would it have made a $5,000 difference last year? Now, guess what? I was doing a live sit-down lecture in Colorado Springs at the University of Colorado Springs at what is it? University of Colorado at Colorado Springs. That's where I was. And I had one fellow raise his hand and say, try $30,000. I said, wow, you would have done $30,000 better last year? He says, no, I would have done $30,000 better in one trade if I'd only known this. All right, so let me go ahead and leave that. 3, 2, 1, close. All right, and share. Okay, now some folks said, I didn't have any losses greater than 5%. That makes sense. That's fine. 14% said I would have been ahead by 500. 29% said I'd been ahead by 1,000, and another 29%, this would have made a $5,000 difference. Wow. And that's just last year alone. Let me ask you two questions. Number one, do you expect to be giving the same answer next year? Right? I mean, a year from today, if I say, hey, did you go ahead and use that married put strategy? Are you going to say yes or no? Okay. Secondly, second question, do you expect to trade for more than one more year? Do you expect to trade for another 5 years, 10 years, 15, 20 years? How much is this information worth to you that I've given you free? Okay, I've given it to you free. All right, so here's the deal. What is so different now? Well, what's really different is Skew. We've introduced Skew. That old trader's maxim of cut your losers short and let your winners run is actually being put to use. A lot of times we hear these trite sayings, but we don't have a practical way of applying it. What I've just shown you is a way to apply it. All right, cut your losers short, limit your losses to what, 5% or less, and let your winners run. Okay, that's what we're doing. All right, now let's see. I don't think we need to go into this fella here. Yeah, we don't need to go into this fella here, do we? You know what? I think I will. I will talk about the Martingale principle here. Okay, because what happens is each time we take a loss, okay, the Martingale principle says this: when you take a loss of, say, 20%, do you need a 20% gain to get back to where you started? No, you need a 25% gain. You know, if you're to lose, if you had $10,000 and you lost 20%, that's $2,000 gone. So you've got eight, and so your $8,000 you've got to make a 25% gain on to get your $2,000 back and get back to where you started. But if you had a 25% loss, it'd be a 33% gain. If you had a 50% loss, think about it. You need a 100% gain to get back to where you started. Now let's take out all the noise in between. Let me ask you something. If a 50% loss means that you need a 100% gain to get back to where you started, what does a 5% loss mean? Does a 5% loss mean that you need a 10% to get back to where you started? No, you only need 5.26%. And what we've done here is we've introduced Skew, right? If you had a 50% losing play or a 100% winning play, right, one that would cut you in half or double your money, right, you would never get ahead if you were wrong more often than you were right. But if you were able to scale this down by 10, you would be able to get ahead, even if you're wrong more often than you're right. Okay, and that's kind of the gist of this. This is what we're doing. Okay, all right. So, oh gosh, we've already shown this. We've already shown the simulations. I don't think I need to get into all that. Sorry, guys. I'm not sure why I'm stuck in a loop here. Anyway, the radioactive profit machine automates the Skew. That's the point. The point is that if you were to buy long calls or long puts and just play those for leverage, a highly leveraged trade can make you a lot of money, but it can also lose you everything, okay, very quickly. And if we play those kinds of plays, but make it conservative by doing the radioactive profit machine in place of a long call, for example, then we are forcing ourselves not to risk too much, and we're keeping the Martingale out of the picture. Okay, all right. What we're doing is automating our position size, and oh gosh, I've done some simulations. Okay, did some simulations on the Radioactive Trading site just a little while ago, and I was showing that, hey, you know, you could actually take your $10,000, roll it up to 80 grand, but still end up bankrupt. On the other hand, you might have more losses and still take your $10,000 and turn it into a very respectable profit with a very low, what do you call it, downturn or downdraft? Whatever that thing is called. Drawdown. There we go. A very low drawdown. All right. And it's all because of automating your position sizing. Okay. Now let's talk about Mike here real quick. Mike has been using the Radioactive Profit Machine for years. One of his plays, he got into SLW, Silver Wheaton, a mining stock. He got in with 300 shares of stock and then 3 put options. Now what happened was he only had 7% of his capital at risk, and only for the first month. He did an income method 5 weeks in, and ended up becoming what we call bulletproof. He paid for the time value of his put. So now he can't lose, and then he was able to actually bring in more funds afterwards with zero risk. We have an income method I won't show today called the ATM machine. Now, you take money out of an ATM machine, right? But only if you put it in first. And that's what Mike did. He started putting more and more and more funds into this, but it was structured in such a way that it did not increase his capital risk. He didn't have any capital risk, all right? And anyway, he ended up making 58.9%, not just on a long haul, but 58.9% on everything that he put into the trade, including 300 shares and 3 put options and several more adjustments that he made afterwards where he put some money in. Okay, so that 58.9% is as conservative as I can make it, but it's still a dang good figure. Okay, now TLM he got into in the same 12-month period, gets into Talisman Energy, and Talisman Energy lost 50% of its value. Wow. But his loss was only 4.5%. And coincidentally, that happened to be his biggest loss of the year. Okay. And so the point is this. If you're going to play stocks that are somewhat volatile and can do very well, they can also do very poorly. What Mike did was he chose to play these kinds of stocks with his Radioactive Profit Machine. And so therefore, when you have 50% losses and 100% wins, and you're wrong half the time, guess what? You'll never get ahead. But when you have 4.5% losses and 58.9% wins, okay, you do very well. Now, here's the formula for expectancy. Your number of wins times your average win minus your number of losses times your average loss. And guess what? Mike was able to control this number, which is a factor or a multiplier of this number, right? So that this whole number is lowered. His average loss, well, shoot, even though his stock over here lost 50% of its value, his loss was only 4.5%, and that was the biggest loss of the year. Okay, so this number is the only one you can actually control. But if you do, guess what? The rest of the numbers take care of themselves. If you take care of losses, your expectancy will rise. And that's exactly what happened with Mike. Mike is able to slay the Martingale. So very, very cool. Okay, so guys, I'm going to transition here, okay? Hopefully I've made a good case for the idea of limiting your losses and using that as a way to participate in the market but not have fear, okay? You probably see the logic of using puts to protect yourself. But would you also like to know how to do 12 different ways to pay for your put? For example, let's say that you have stock, you've also got a put option, but your combined cost basis for your stock and your put option is lower than the strike price of the put. What does that mean? That means you can't possibly take out less than you've put in. That means you're in a position that we call bulletproof. Would you dig that? Would you like that? Would you maybe even like for me to show how to do that? That'd be kind of cool. Okay, so let me go ahead and leave this pull up for about another 5 seconds is all. And 3, 2, 1, close. Okay. Now you can vote in more than one category. So let's take it from the top. 88% said, I like bulletproofing. Yeah, you do. Bulletproofing is just a fabulous way to go. You know, when I was in my mid-20s, I bought a trampoline for my daughter. who was 3 at the time. Really responsible parenting. And what I did was, jumping with her on it, and I did a front flip, and she said, "Oh, that's awesome." She says, "Daddy, do a backflip." And I thought, yeah, okay. And I began to do a backflip, and about halfway through it, I mean, I'd already left the trampoline. Halfway through it, I thought, man, what if this isn't as easy as they make it look on TV? And I came undone, and I ended up landing on the edge of the trampoline with really lousy timing. My feet folded under me, and I ended up falling off of the trampoline and onto the ground. Well, that sucked. But I was going with my daughter in the Chapel Hills Mall. And in the mall, they had this setup where there's these gimbals and these straps and these bungee cords and so forth. And there's a trampoline, sure, but holding you in place is this wonderful harness that makes it so that you can't fall off the tramp. You can't fall off the tramp. And I thought, wow, I'm going to try that. And I found out that my body, in my 20s anyway, my body was capable of doing double front flips and triple backflips. And it was just the difference between having the fear of getting killed and, releasing the high performer within because the fear was taken away. Well, guys, what about this? Would you like to be able to trade with a net? How about that? That'd be something else. Okay, so let me hide this. 13%. Well, I'm sorry, I didn't do the whole thing. 38% said, "Wow, this is just what I was looking for." Yeah, I know. I mean, this is what I was looking for when I got hurt in the late 90s, trading covered calls. Bad idea. I was trading covered calls. I was doing it on margin. I ended up getting hurt really badly. Okay, so this is the sort of thing I would have been looking for. 13% say I've paid over $3,000 for a less complete solution, and 13% more say I don't know if it's worth it. Let's hear the offer. Okay, so all right, let's talk about what else is different now. Well, what else is different now is that within the context of your RPM, your radioactive profit machine, income can be generated 12 different ways using the income methods. And since I promised you, I'm going to show you one, but I'm going to show it to you live. Okay, the income methods enhance the skew. Let's say that we've got that skew in place. What if we reduce our cost basis? When we reduce the cost basis, we're skewing ourselves even better. And you know what? If you don't skew yourself, you're going to screw yourself. It's very important. Okay. Now here's a play that I did back in February, where I had purchased Caterpillar and also the 8750 put option. Okay. Now look at this other play here. This other play is what's recognized as a bear call spread. Bear call spread. All right. Now the bear call spread is where you sell one call and simultaneously with some of the money buy another call. Okay. So we're selling the 85 calls and buying the 8750 calls, and we're generating 80 cents. Okay. $1.23 income. 43 cents outgo, and so that's 80 cents in. Okay, what's that do? Well, it creates a little bit of a different picture. Instead of this, we have kind of a check mark. I don't know if I got it prepared. Maybe I don't. But two things. Number one, either that stock continues to go up, and you do very well, or it travels along sideways and you get to keep your 80 cents, or it goes down and you still get to keep your 80 cents. What happens though is that income offsets your cost for your stock, and you can do this repetitively. Remember, I started out with a put option clear out till August, and I'm doing plays in February, I'm doing plays in March, I'm doing plays in April, right? Plays in June. And so what can happen is we can actually completely eliminate all risk. So applying the income methods, you lower your cost, your risk, or your cost basis, or both. And you may end up with a married put with all of your time value paid for, but your upside left intact. We call this bulletproofing. Okay. All right. Now, I don't think I set myself up correctly to show you this right off, but I'm going to go ahead and get in there. Here's power options. An earlier poll told me that only 20% of you are subscribers to Power Options, so I'd like to fix that. Let me give you a link. I'm going to send it in the chat box right now. A link, www.poweropt.com/RAT. Now I'm sending that as a chat. That's a clickable link I just sent to everybody. And what that'll give you, courtesy of Radioactive Trading, it'll give you 2 free weeks of Power Options, so you can test drive everything that I'm showing you. What I'm going to do right now is go to the married put position here, and what we will do is we'll just search. We'll do a search, and we'll find boatloads of married put opportunities. Look at that. That's marvelous. Okay. Now, what I'd like to do is I'd like to maybe just jump into one of these guys. I'm not going to actually buy the stock, although I've done that before. But let's go to Skyworks. We'll do Skyworks. And what is Skyworks saying we should get? A January 115 put option. Okay, good. All right. So I'm going to zap up here, and we're going to go to the custom spreads, and we'll use the present price of Skyworks. What is it? SWKS? Something like that. I'm going to show you that and also show you the income method number 6. Okay. All right. So SWKS. We're going to add the stock. I'm going to buy 100 shares. At the same time, we're going to also buy a put option. It's far away in time. I think it was January that it was talking about. You know what? Let's not go to January. We'll go out just a little less. Okie doke. $110 put option. And this will grab the natural ask and bid price. And I'm going to show you how to, and now, by the way, I've got to mention right this second, I'm not making a recommendation. I'm doing a demonstration. Okay, I'm not making a recommendation. I'm doing a demonstration. I'm showing how the radioactive profit machine works and how one of the income methods works. Well, that's 8.6% risk. So you know what? I think that's a little too much risk. So what I'm going to do is I'm going to go for a different put. Let's go for August. A little less risk. All right. And we'll submit that play. Now let's take a look. Okay, so I'm not making a recommendation that you play this. What I'm doing is I'm showing you how to play it if you do. So now our risk is kept less than 6%. It says 5.8%, but I'm going to say that it's really more like 4.5% or so. And here's why. I don't have any intention of holding this clear out till August unless it shows me something. And if it shows me something, I'm going to bulletproof it. Okay, then I might hold it to August or beyond August. With one of our income methods, we can extend the life of it. All right, but here's the deal. If I get out early, I'm going to lose less if I'm wrong, and I'm going to make more if I'm right. So how much is our risk? Our risk is 672. I've got an idea. Let's reduce some of that risk, and I'm going to show you income method number 6. Income method number 6 is where I would take a near-term bear call spread and form that. Bloop. Bloop. There we go. Now, if I sell the 110s and with some of that capital buy the 115s, here's what will happen. I'm going to generate $1.20 per share. What's that going to do to the chart? Well, look at what happened to the chart. I still have unlimited upside. Those of you that trade covered calls and think that the only way to take income is to trade a covered call and cut off yourself off at the knees, okay, guess what? Take stock of this, not to make a pun. This is kind of a cool idea. I still have unlimited upside, don't I? All right. And if I get out early, my upside is even better. Okay, kind of cool. All right, so what's happening here is we took our risk. Our risk had been 600 and change. Now it's only 553. Okay. Now here's the risk that would normally go with doing a bear call spread. The risk that would normally go with doing a bear call spread is you'd take in you're $120, right? But if the stock goes up, you're going to lose much more than what you gained. You could lose as much as $380. So I'm gaining 120, or I could lose 380. But in the context of the married put, what if the stock goes up? Well, we saw it already. It's unlimited upside potential. I'll add back in the stock, right? And add back in the put option, and you'll see that the 120 that I just took here is riskless. We're taking that income risklessly. Kind of cool. Okay. All right. So hopefully I was able to make good on all the promises that I made to you. I promised that I was going to show you how to participate in growth. I told you I was going to show you how to take income from a stock while you're sitting on it. And I told you that I was going to show you how to bulletproof, because guess what? If you do this repetitively, or if you make an adjustment after your stock goes up like this, there's other ways to make an adjustment and bulletproof yourself. There's a possibility that, hey, now you've got a stock plus a put option that the cost basis is less than what your put strike price is, and then you become bulletproof. It's kind of cool. Okay. All right. So hopefully I made good on all my promises. Guys, I'm going to go back to the slideshow, and I'll take some questions if you have them. Okay. Quick reminder, you may not get all of this in the first viewing. All right. So that's okay. If you happen to, for example, like Jill has recently purchased the Blueprint, and William is a veteran owner of the Blueprint. If you want support, just write in to us at support@radioactivetrading.com, and we're real quick to help you out. All right. All right. I'm going to give a final poll. This is the last one. This is it. Okay. What is the single biggest objection that you have to getting the home study kit? What is the single biggest objection that you have to getting the home study kit right now, today? If you don't already have it, we've got a number of folks on the line that have already picked up the Blueprint. Okay. All right, we've got 2 of the 5 categories. No, we got 3 of the 5 categories. I'm laughing along with some of you. Okay. I'll leave it up there for about another, 10 seconds or so. This is our last poll. There's nothing more after this. What is the single biggest objection that you've got against getting the Blueprint, or the home study kit, I should say, the home study kit right now? Okay, let me go ahead and close that poll in 3, 2, 1, close. Okay, and here's the deal. 20% say, I think it's pricey at $600. Okay, well, maybe. But many of us have gone to these weekend seminars for $3,000, so it's 5 times as much, $3,000, and only learned one income method. We learned how to trade covered calls. Or maybe we went to the call spread seminar. Okay, so we learned how to do call spreads. Okay, this is 12 different income methods plus a setup that will keep you out of trouble. And nobody ever taught me how to keep out of trouble. That's why I went broke after my weekend $3,000 seminar. You know, back in the 90s, I was a noob, just like some of you. I was a newbie, and I got killed. Okay, I got killed because nobody showed me how to stay out of trouble. We're going to show you how to stay out of trouble. What's that worth to you? Also, what's it worth to know 12 income methods instead of 1? Now, 60% of you said, I'm scared of getting my hopes up again, okay, and not being delivered on the promises. Well, that's a good objection, okay? That's a good objection. I'll address it. 20% say my wife or my husband will shoot me if I get another course. And you know what? I sympathize. I've got a wonderful wife that keeps the reins on me. You know, if I say, hey, honey, this is great. It's wonderful. She says, how great and wonderful is it? All right. Well, here's the thing. First of all, it's not pricey. $600 is actually a very, very reasonable rate. 60% of you, you're scared of getting your hopes up. Okay, well, the guarantee ought to handle that for you. Okay, we get 100% money back guarantee. I figure if I'm going to teach about bulletproofing, I should have a bulletproof offer. And, we've been in business for over 10 years delivering exactly that. Okay. If your wife or husband is going to shoot you if you get another course, what about if you get another loss? What if you get another loss that's greater than what this course will cost you? Think about that. Think about the end time. Okay. All right. Jill just mentioned when you purchased the Skyworks put, it was in August. Isn't that a shorter time frame than the blueprint formula, or is it okay because of the spread trade? Good question there, Steve. I'm sorry. Good question there, Jill. I looked at the traditional married put, out to November, and it looked too risky for me. And I had already committed to showing you a Skyworks trade. I didn't want to go back and redo it. So what I did was I thought, well, okay, let's take a look at another expiration month and see if it flies, see if that works. There is some flexibility to it, yes. Okay, cool. Let me go ahead and hide this, and we're going to finish up here. I'm 15 minutes past the hour, and that's when we traditionally finish up. Okay, so let me go ahead and mention this. The income methods are used to reduce the gap between what you've spent and what you're guaranteed to get back. All right, and then once you reduce the gap to lower than what you're guaranteed to get back, we call that bulletproof. Okay, if your cost basis is now less than your strike price, now you're bulletproof and you can continue to use the income methods or just sit on it. It's kind of cool. Okay, so here's what to do next. What to do next after this primer. We've just given you some basics on limiting risk and bulletproofing stocks. Well, the first thing I would do, the first step would be to look back at your own trading record and determine, hey, would it have done better? Many of you told me yes. Many of you already said, it would have been a better year if I'd have done that. 78% of you told me it would have been a better year. And then when I asked how much better, all right, what did we say here? How much better? 29% of you said, pretty much the same. And but the other 71% of you said I would have saved or made enough to be ahead by $500, ahead by $1,000, ahead by $5,000, and that's just 1 year alone. Okay, not bad. So let's think about it. If this would have improved your trading record, what's that worth? And what's that worth over the period of the next 5, the next 10, the next 20 years of trading? Okay. Number 2, consider how different things might be if you also took income. If you were limiting your upside by way of covered calls, what about the thing I showed you just now, where your upside would not be limited, but you could take a respectable credit? That's pretty cool, isn't it? Take a respectable credit of, $1.20 or so a month. But at the same time, if your stock goes up, hey, your upside is not limited. Were there any instances in which you were trading covered calls and you gave up a winning stock? It would have been better for you to hold it. Well, the Radioactive Profit Machine method will show you how to do that. Okay. Here's another thing I do. I grab the free trial. I already sent you this link, but I'm printing this now for the folks on the recording. It's www.powerop.com/RAT for radioactive trading. No credit card is required. These are just my good friends over at Power Options. They want you to have a 2-week test drive to that tool. Okay, get 2 free weeks and try it out. Everybody in the office, by the way, trades radioactively. It's interesting because they have double diagonals and iron condors and butterflies and all that stuff available to them. But what folks are using with their retirement accounts is my method. Okay, so think about that. The boys over at Power Options are using radioactive trading with their own money. Okay. So go to powerop.com/RAT for 2 free weeks. And you can also get set up for a private consultation. Okay. And finally, if you think you do well to learn the other, the other 11 income methods, all right, pick up the blueprint at radioactivetrading.com. And the blueprint is actually not $600. It's $339 for the blueprint. It has a 100% money back guarantee. If I'm going to talk about bulletproofing, what I need to give you is a bulletproof offer, I think. Okay, and so that's the way we want to have our relationship begin. And for those of you that have stuck with me through thick and thin. I sure appreciate you. I'm going to, I'd like to try and do something different here. Is anybody still on the line that owns the blueprint already? And would you be happy to say a few words? I think I might be able to unmute you. And that's not a guarantee because I've actually never done this. But I wonder, is there anybody on the line that might want to say a few words about the blueprint or the home study kit? I don't know if I've got any of my current owners still left. Okay. All right. Either I don't have my owners left, or we're being shy, and that's okay. What I'm going to do is give you this printed deal here. It says, "Dear Kurt, I've received the blueprints and I'm a total believer in the methods. Thank you so much for sharing the idea of bulletproofing my stocks." Now get this, guys, this is important, okay? Because earlier in today's class, I showed what the consequences could be if you lose more often than you win. Can you still make money if you lose more often than you win? If you lose 60% of the time? Well, look at this. He says, in the last 6 months of trading, even though 6 out of 10, that looks like 60%, even though 6 out of 10 growth stocks cratered, I was able to manage all of them with absolutely no loss. Well, how is that possible? Well, he bought stock and also bought put options that offset the risk, and he also did income methods, got out early, and was able to get out of the losing stocks with no loss. Kind of cool. He says further, in some of them, I even made money. And that's possible. You can actually collect a certain amount of income and then sell your stock and your put separately and actually come out ahead even though your stock went down. I wish I had known about bulletproofing a year ago. I'm still recovering from some huge losses I've incurred a year ago. This is back when Sudhakar was trading a different method. But since having gone through bulletproofing methods, I'm very excited to use put options more gladly than ever before, and I am slowly making my progress. What's most heartwarming for me is that almost all of my portfolio is bulletproofed. Thank you again so much for the blueprint, and that was Sudhakar Rajalu. So thanks a lot there, Sudhakar. And folks, I'm going to recommend that you run over to radioactivetrading.com and pick up the blueprint. And with that, I'm going to go ahead and close up today's class. If you think of any questions that would have been perfect to ask during the class, just like always, you hang up the phone and you think of the perfect thing to say. What I'll recommend that you do is hit me up at support@radioactivetrading.com and be happy to answer your questions. Okay. All right, folks, we'll see you out there. Happy trading and bye for now. Thanks for your dedication. You're welcome, Joe. I appreciate you. All right, we'll see y'all.